With all three major ratings agencies now rating U.S. debt below AAA, is it time to rethink what risk-free really means? We're going to explore the impact, the symbolism, and the investment takeaways right now on UBS Trending. Hello again, everybody. Thank you for joining us. My name is Anthony Pastore, and this is UBS Trending. Here with me in the studio today is Alejo Cherwanko, Chief Investment Officer for Emerging Markets here at UBS, and our Chief Investment Office. So, Leo, good to have you back.
Thank you for having me.
Somebody might wonder why the Emerging Markets Analyst is here sort of having a conversation about the downgrade of U.S. debt. But obviously, it's not just the U.S. that might potentially be impacted by a ratings downgrade. So let me start with you, because I'm sure a lot of folks out there saw the headlines, but maybe they don't really understand the impact of what that means. So when Moody's, for example, downgrades the debt of a country, what does that actually mean?
You got to think about sovereign credit ratings like school grades. When you were younger, Anthony, you went to school, your teacher graded you for a particular class based on midterm, final, projects, class participations. So in this context, teachers are credit rating agencies, countries are the students, and they're being evaluated on their ability and willingness to pay back sovereign debt, right? And so this is the context for the last 100 years. These quote-unquote teachers, credit rating agencies, Standard & Poor's, Fitch, and Moody's have been giving out grades to countries. On the lower end, CCC, on the higher end, AAA, and everywhere in between, right? They look at a whole range of indicators to assign this grade, let's call it. They look at debt to GDP, deficit trends. They might pay attention to whether debt is short-term or long-term, meaning what's the likelihood you have a rollover debt, right? Is this debt local currency, foreign currency, among other indicators, institutional quality of the country, right? And again, they conclude debt is more or less sustainable. As a country, you're more or less able and willing to pay it back.
Right. That's a perfect analogy. Thank you for putting it into those clear terms. Even thinking about having to get grades as a kid in school, I actually got a little bit of like shivers down my spine, because it is one of those moments where you anticipate what's the teacher going to grade me on this particular project, final test, etc.
But here's why the analogy works, because as a student, before you go take the test, you kind of already know, right? You know what your grade is going to be.
That's
so
right.
By the time you get the grade, you should rarely be surprised. And I think this applies squarely to the Moody's decision.
So the U.S. shouldn't have been surprised. I don't think CIO is surprised. As it was, Fitch and S&P had already downgraded U.S. debt. So when Moody's kind of followed suit after a while, it probably didn't come as much of a surprise. So that begs the question then, does it really even matter at this point from an investment perspective?
That's exactly the point. So Standard & Poor's downgraded the U.S. from AAA to AA+ in 2011. Fitch did the same in 2023. So here comes Moody's. What's the additional information content from this decision? It's really limited, right? So we're not learning a whole lot. Symbolically, it does matter. Nobody wants lower grades. Realizing as a student that you're not the exceptional student you used to be, it's not a nice thing.
Right.
But the reality is the U.S. is still a very, very good student. And when you compare it with other folks out there, your grade is still very high.
Right. So it's almost like if you wanted to say that A+ on a grade for a paper is a AAA rating from the ratings agencies, what is this, maybe like an A or an A-? So it's still a good grade, it's just not the best grade.
That's correct.
Okay.
And when other people around you are not doing as well either, right?
And they're getting B's and C's.
There you go. Your A doesn't look that bad either. So market impact, it's limited. Now, we shouldn't conflate Moody's decisions with other developments that are going on as we speak.
Sure.
Congress is debating a budget. I think few people would define this proposed budget as fiscally responsible. I think it's fairly fiscally irresponsible. As it stands, deficits are projected to grow to 7% of GDP plus in a context in which debt to GDP in the United States is already north of 100%,
And
right?
it could go higher.
It will go higher according to a broad range of independent estimates.
And I wonder then if the ratings agencies will have to come back and reevaluate the U.S. and perhaps change their ratings yet again after we see the debt to GDP increase again.
I don't think we can rule that out.
Right.
That is the harsh reality of an environment in which Democrats, Republicans, nobody is displaying what's needed to consolidate fiscal accounts in the United States.
Okay, good. So then here we go. Now you're our emerging markets chief investment officer. How does this story that's happening in the U.S. now other countries all have ratings from these agencies as well? What's the impact from this U.S. downgrade potentially on some of the other countries, especially those that you cover in the EM universe?
Absolutely. I think we need to recognize that over the last 15 years, Anthony, sovereign credit ratings have, by and large, trended downwards across the board.
Right.
In Europe, in Japan, in most of the emerging markets, you'll find a few examples of countries that have improving credit ratings, right? You may have to look for Greece in Europe or Brazil, Dominican Republic, Argentina, and Latin America, but few and far between. We're living in a world in which fiscal irresponsibility rules.
Right.
That's why when you're thinking about impact, right, the United States Treasury market, $27 trillion big, the deepest, most liquid bond market in the world. The analogy that you've heard me say before is, in the land of the blind, the one-eyed man is king. You cannot replace this. Even if you're rated now AA+, which is not AAA, not ideal, you cannot replace this. So I think in this environment, Anthony, we gotta get rid of extreme conclusions. It's not black and white. You gotta start thinking about shades of gray, right?
Yeah.
The US is not as great as it used to be. I think that's a fact. But other countries are having challenges too. Therefore, the US Treasury market is not gonna collapse. The US dollar is not gonna collapse. It's an evolution, not a revolution.
Right, and I'm imagining, because it's certainly a question that I've had, and I'm sure a lot of other folks who are coming to you and saying, will this impact the status of the US dollar and this US exceptionalism that we've been talking a lot about since Liberation Day? And there's also sorts of other uncertainties that exist right now with tariffs and what the Fed will do later this year, if anything. And so that's probably the biggest thing you're getting. So with the US still at the core of this story, and still, as you said, the one-eyed king, to use that example, how does that help with investors who are looking for greater diversification and looking for ways to make their portfolios make sense in the environment that we're currently talking about?
Totally. I do believe it's a healthy debate to say, hey, U.S. exceptionalism.
Yeah.
Does it stand to the degree we thought it did? The U.S. dollar, it is expensive by any metric, right? And the reality is people are looking for alternatives at the margin. So we would say, Anthony, you gotta have a core of your portfolio in the United States. United States stocks, United States bonds. That is going to be the reality, I think, for years to come. However, it is crucial that, say, in the US, in the stock universe, 65% of your stock allocation is in the United States, but you still have a 35 to 40% allocation outside of the United States, given valuations, given fundamental developments, given the overall trend of US dollar. We think the US dollar will weaken in the next few quarters. We think the US exceptionalism debate is going to be present. We're not going to have a clear black and white answer, but some people are going to think, maybe at the margin I should allocate somewhere else. So in our view, in our analysis, you got to have geographic diversification. In addition to a very strong foot on the United States, you got to be allocated to Europe, you got to be allocated to Asia, and you got to be allocated to Latin America.
Excellent. Alejo, thank you. I really appreciate you walking us through this because it can be confusing for folks out there who don't know the historical significance of these ratings downgrades and what it means today and how it compares with other countries around the world. So this was really terrific. Thanks for doing that for us.
Anytime.
Great, good to see you. Alejo Cherwanko again, the Chief Investment Officer of Emerging Markets here at UBS. And thank you all for joining us. I'm sure this conversation helped maybe clear up some of the questions you might have had regarding this story, but there's a lot more information on this and more at our website, ubs.com/views. That's our insights page, all the content coming out of our Chief Investment Office and then some. Plus, you can follow UBS on social media. We're on LinkedIn and Facebook. We're also on Instagram. You can follow us at UBS Trending, a dedicated page just for UBS Studios content. And as always, if you have any questions about your portfolio or what Alejo and I spoke about today, make sure you're continuing this conversation with your financial advisor. Until next time, I'm Anthony Pastore. We wish you a great rest of your day. And remember to keep your eyes on what's trending. See you soon, everybody.